Good morning, good day, good afternoon, good evening, wherever you are in the world. My name's Alex Wenham, the digital asset product and strategy lead at Bloomberg. And it's my pleasure today to host a very special fireside chat on leading the charge in institutional adoption of digital assets with Mathias Imbach, Group CEO and co-founder at Sygnum. So Mathias, welcome.
Thank you, Alex. It's a pleasure to be here and look forward to the discussion.
Great. So maybe we can just get kicked off, a little bit of an introduction, perhaps about you, how you kind of co-founded Sygnum, what Sygnum's mission is, and kind of how you see the market developing for Sygnum. I know you had a recent funding round, so that would be great context to kind of start the discussion.
Sure, you can think of Sygnum as a digital asset banking group, really focused on institutional needs and bringing trust to the ecosystem. We are 4 co-founders. We launched it, or had the idea, at the end of the Singapore FinTech Festival in 2017. It was a time, where we had a bit of a hype cycle. At the times, lots of ICOs going on, and we just believed in the disruptive potential of the blockchain technology, but also felt that future as heritage, and some of the things that were happening were a bit detached from reality. So we had the early thesis that at some point, if we really want to move towards institutional adoption, also the topic we're going to talk about today, then we need to accept, again, that future as heritage. We need to go fully regulated, and that's what we've done. So we're a licensed bank in Switzerland, but also fully regulated in Luxembourg, Abu Dhabi, and Singapore. So really focused on Europe and Asia, and follow an all-in-one account approach towards digital assets, meaning crypto, stablecoins, asset tokens, ranging from custody, staking, trading, asset management, and tokenization. And I am dialing in today from Mumbai, which also kind of links it to my past. I used to, before co-founding Sygnum, manage the family office of Ratan Tata, an Indian industrialist. And I'm here actually to visit basically my past friends right now, and before was with Bain & Company.
Great, thank you. So you mentioned a little bit about the kind of that you're regulated in Switzerland and Luxembourg, and I believe also most recently in the UAE, and before that Singapore. So you're a global business. I believe you kind of have customers from almost 60 different countries. Obviously with crypto, the global kind of regulatory scenario is quite mixed. And when you kind of couple that with, where high net worth clients are, and kind of crypto adoption as a percentage of kind of population, some of the areas where you're not yet kind of regulated are kind of relatively high kind of domiciles of crypto adoption, but also kind of high net worth clients. How do you kind of think about the expansion of your business in the context of kind of regulatory environment?
Yeah, so first, we very early on and strategically decided, and that has not changed, to not get into the US, which also is a big market, right? But we decided early on that there was so much uncertainty regulatory-wise that we would like to stay away. And I think in hindsight, till today, even though there's some interesting and also more positive developments happening as we speak, this was, in our view, a very good decision. So we are strong at the interface of Europe and Asia, and this is also where we have set up. We have started with Switzerland and Singapore because we felt these are strong financial hubs with a high reputation, and also we're moving faster than others in establishing clear guidelines and regulatory and legal frameworks that allow us, and allowed us also in the past, to do business in a way that we can feel comfortable and bring trust to the ecosystem. So it really started off with this dual headquartership across Switzerland and Singapore. Switzerland moving even a bit faster than Singapore, and this is today also our biggest hub, where we also have the full banking license. Then in terms of when we thought about the further expansion, this is something where we have to be agile. We were basically looking at in which regions do we see crypto adoption, openness also from the regulators and the legislatory bodies to adopt and create frameworks for crypto that allow for a business like ourselves to thrive and grow. And so that then led to the extension into Luxembourg particularly for the funds business, but also Abu Dhabi, Dubai, then in the Middle East, because there was a big move of companies and also individuals to the Middle East, and the local authorities really worked hard towards establishing frameworks that allowed businesses like ourselves to go there. As a next step, we're thinking obviously about the further expansion into the EU, given MiCAR coming up next year. And also Hong Kong has made some strides into trying to establish more clarity. We believe it's still a bit more early than sometimes projected there in terms of some of the rules that they have set out. But we are also looking at this particular market as a next step.
When I was kind of looking into the questions and some context around them, I was quite surprised that the UAE has roughly 30% kind of ownership of crypto as a percentage of population. I was completely surprised by that. And of course, I think that was the most recent area that you had set up. Yeah, if you kind of had a bit of a crystal ball, like what's the next area that you think kind of starts to create the right kind of conditions for Sygnum to think about setting up a business?
You mean the regionally? Okay.
Yes.
Okay. So I personally hope for the overall adoption of crypto. I very much hope that the US will, over the next 2-3 years, become, establish more clarity. That will not mean necessarily that we will want to expand there, but for the overall ecosystem and just also for the general, for everyone globally, it would really help to have that sorted. So that is one. I think that's the big elephant in the room. It's highly political and the implications are manifold and very significant. If we think about the Ethereum, is it a security discussion? The upcoming ETF approvals today. There's going to be a Senate vote on an important bill which impacts crypto, etc., etc. So these things I do hope. But beyond that, when I focus on our regions that we have our strongholds, obviously in the EU, which we then have with MiCAR from 2025, if you have the right regulatory framework or license, you have access to the whole of EU, which we do expect over the next 5 years to become a big growth engine also for ourselves. So that is clearly one. Second is really that Singapore, Hong Kong as the two hubs in Asia. We believe these are the best hubs to operate from, and then obviously via cross-border arrangements, you also tap into other markets. Japan is an interesting market, but a market that you clearly cannot try and go and do something yourselves or alone. It's just not a market that is suitable for this, but maybe via joint ventures. Some have succeeded. And then I think that's it. So that's how we currently thinking about, and have more than enough on our plates with that.
Yeah, sounds like it. And I think we'll get a little bit of context from the US, depending on whether Joe Biden kind of vetoes that bill, I believe, that passed the Senate recently. So let's see on that. So maybe let's get stuck into some of the broader challenges of kind of institutional adoption. So I know when we've been kind of chatting before this, and in general, when I kind of meet customers, and both from traditional side of customer base and also the crypto native side of customer base, that these two worlds are not necessarily entrenched yet, right? There's definitely, I guess, first and foremost, a infrastructure misalignment of what blockchain and DLT can do and where the kind of current state of traditional client technology is. So maybe if we start within the infrastructure area, with that kind of context, where do you think, or how is Sygnum looking at kind of being the kind of, let's say, merger of two worlds from a kind of infrastructure perspective?
Yeah, that's a very, very good point. And I think it continues to be a key challenge, even though we are making strides and we are moving ahead. So if you think 4 years back, there were just a fraction of the on-off ramps and traditional finance with crypto integrations via credible players versus today. So 4 years ago, there was hardly any. It was just literally emerging. It is tough to do because it's not just adding another asset into an existing core banking system. It's a new technology, it's a new infrastructure. It comes with new processes way beyond technology. I always say the technology part is just the tip of the iceberg, but you need to really redefine many of the processes when it comes to risk, compliance, etc. And as a result of that, many of the particularly banks and financial institutions that typically manage wealth for still 99% of global assets, they have just not yet established this infrastructure. However, these works are going on, and specifically Sygnum, the role we are playing there is by providing sub-custody trading, basically bank-to-bank services to now more than 20 banks. In Switzerland, we are clear market leader. And we have also, for example, a system-relevant bank with more than 2.5 million Swiss customers fully integrated with our systems. That means via the app, almost a third of Swiss population just with this bank can trade crypto now. And this was missing and is a key component for further adoption. Just ease of use. You can do it with the trusted partner that you already know. It's integrated with the rest of your portfolio, etc.
Okay, so I guess I come from an FX background traditionally, so it's kind of like a white labeling of the technology so that banks can kind of leverage your tech stack within their own kind of infrastructure and give clients access to this new market. No, makes sense. So you also
so just that it's if I can just add, it's clients do not know that we are in the background, right? It's completely white labeled and it's modular. It can be trading. It's usually custody and trading. It can also be crypto AML services. We have by now banks that integrate our crypto AML tool to do chain analysis and other things. So it's modular, yes, depending on the needs.
But more than just kind of liquidity provision as well. That's interesting.
Yes.
I think we mentioned custody a little bit, right? So there's obviously kind of like a traditional, I'd say, crypto version of thinking around custody linked with trading all in one kind of happy family in the traditional market of way of thinking about it, where these services are segregated for good reason. So, are you kind of supporting clients in this? And if you are, how are you doing that?
So one of the big changes over the last 2 years was just more broadly before focusing on custody is that people are starting to seriously look at counterparties and analyzing the tail risks before depositing significant monies, particularly those players that are managing third-party money, because they can be liable for if they are reckless in terms of not analyzing the counterparties. And this was manifesting itself obviously after FTX in particular. And what we could really drive home here is from a Sygnum perspective that as per the Swiss Banking Act and our legal frameworks, crypto assets that we hold, we custodize, they are completely off balance sheet. That means if you hold your assets with us, you can never get into a bankruptcy proceeding, even if something bad happens to Sygnum, which touch wood would never happen. But you have that legal certainty for a tail risk that whatever happens, you're not caught up in some Chapter 11, your assets are with you. And that's a big deal because it significantly reduces counterparty risks. Then this is the one part, which is I think it's one of the absolute core value propositions that we offer to the institutional market. Secondly, is we've realized that obviously the way the market is structured and where the liquidity is, you still have a few very large exchanges. There's still one exchange having more than 50% of trading volumes on its platform. And this is a counterparty that many, particularly larger players, would not like to be super comfortable keeping lots of cash and or stable coins, etc., as deposits on a continuous basis. To manage this counterparty risk, we have developed a product called Trade Collateral Management, which allows these customers to have a tri-party agreement where the exchange has the same client as ourselves. The client can deposit significant monies with us, off balance sheet. We can, for example, and then there's a virtual margin so that they can keep trading on these exchanges, which maybe are less regulated, but where the liquidity is, and where they have many options, so they get a virtual margin, but the assets are with us. And as a bank, we can obviously also help them invest, for example, in US Treasuries, so they even get a yield on the collateral for the margin. So it really is a win-win-win scenario, and is one of the fastest growing products right now.
Oh, super interesting. And so maybe if we're talking about, so we discussed like a regulatory environment, we discussed a little bit about kind of the infrastructure and now custody. I mean, to me, the million-dollar question when we think about our client base and how we think about evolving our own kind of crypto products to meet their need is where does crypto assets belong in an institutional portfolio? So, we've just seen the 13F filings from the Bitcoin ETFs that launched in January. There were a couple of surprises there, like Millennium with a $2 billion exposure, and another couple of random pension funds that were in the mix. But when we think about, or when you think about, and you're offering and where you're kind of targeting your solutions to institutional clients, where does crypto belong in kind of the institutional portfolios that consist of equities, fixed income, and more increasingly alternative assets?
Yes, this is a very good question, and that I believe first statement I want to make is we're probably still very early. This was now the first time we saw these 13F filings, which was highly interesting, and actually many more also in terms of numbers, not necessarily the size only, but also in terms of number of institutional players. It was a big surprise in terms of how many have already gone through the due diligence. But we can expect that this was just the start, because for many it will take longer to complete their due diligence and governance process to even start allocating. So I'm quite positive about this continuing. So that's maybe the first statement I would want to make. Secondly, in terms of how do you think about where it fits in a portfolio, for us, we try to tell our clients and prospects that they should start thinking about it more as an asset universe within which you have the different components as you have into traditional asset classes. You have basically an equivalent to venture by having focused venture vehicles to invest in blockchain infrastructure and technology. You have then the hedge fund strategies for alpha with funds of funds, etc., that allocate to crypto. You have the smart beta exposure via indices, for example, that can be in ETPs or actively managed certificates. Then you have the yield equivalent in crypto, which could be yield strategies also packaged in actively managed certificates. And then you have the pure beta equity equivalent, or basically a situation where you just have long investments in, for example, an ETF, or if you actually want to hold the Bitcoin or ETH, etc., directly. So we are trying to not just create the framework how you allocate crypto as one fits all into the overall portfolio, but also within your crypto portfolio to start diversifying and think of it as an asset class itself.
Right. So one thing I've always thought was amazing around the work that you do is the kind of types of clientele that you service, particularly kind of the more, I guess, growing or niche area of finance, which is the kind of crypto native treasuries, crypto native DAOs, where they have, capital to deploy. And increasingly when interest rates were going up, it made more sense to start deploying some of that capital into the traditional finance world rather than some of the crypto native strategies. But, when you look at the legal structure, let's just say something simple like that of a DAO, I mean, there's cases that I think now are settled in the States where, I think it was owners of the MakerDAO token were suing some of the largest holders because they thought that the kind of corporate structure was more like a kind of partnership rather than a kind of limited liability company. So, when you think about due diligence of a DAO in terms of thinking about working with their treasury, how do you even start that process?
Yeah, so a lot of what we do is again that combining this bridging function of this future as heritage thought. So we have always, in whatever we are doing, is we're saying we're working towards building future finance, but we accept that there's rules and frameworks and governance and regulation that are to be upheld no matter what. And what we do in such situation, right? I mean, we have but more than 70% of the top 50 or so crypto projects are working with us in various capacities. You can imagine that we're almost writing books when it comes to the due of these entities and people and clients. So it is all about making sure that we can follow today's rules into the framework, which can lead to situations where we cannot always offer the full banking suite. We cannot, for some, it's a very limited offering where you can say for XYZ reasons, because we cannot have full details on what is needed for a certain product. We then have a very limited offering for a certain entity. That can be one outcome. Or otherwise, if everything is clear, which is obviously linked to source of wealth, etc., then it's really just also educating them about the benefits of traditional finance. I always say at Sygnum, we may in the morning meet the CTO of a crypto foundations, and in the afternoon the CEO of a regulated bank, and we need to be good counterparties to both, and basically bridge that they can then ultimately come together and work also together. So that is our role. We have seen in the last cycle or in the last year that many of the, for example, crypto foundations, as you hinted, they've started to allocating parts of their treasury away from pure Bitcoin or ETH beta into treasuries to hedge their portfolios or to have it more. And obviously, as a Swiss bank, we can offer both. So we have then the ability to offer access to traditional financial products, but then also in one portfolio, for example, hedge their beta Bitcoin exposure with option strategies, etc. And for that, you need that regulatory overlay because you then get into managing securities, which it's not debatable that they're definitely securities. And for that, you need that regulatory clarity and license. And that's what we bring to the table. So this is a very complex, it's a very complex topic. And ultimately, where we are strong, or what our USP ultimately is in one sentence, is whenever you have blockchain technology related applications that meet financial products, financial services in a fully regulated manner. And if there's this overlap, wherever these three things overlap, this is where we want to focus on.
Well, I do hope you write a book on that. I'll definitely be a bidder of that. So maybe if we move to tokenization in general, I know that Sygnum has been very big in this space. I think in the early days, you were looking at kind of tokenizing the fringe kind of side of alternative assets with artwork and fine wine and whiskey, and more increasingly been moving into kind of private markets. Where do you see the kind of context of tokenization of real world assets, and in terms of what your client base of high net worth clients are kind of looking to invest in? Where are you seeing the future of that going?
Yeah, first of all, I have stopped predicting where this is going, because I've been, and I'm not shy of admitting this, been very wrong how in terms of the speed of adoption. I thought it would be much faster, so maybe that's first. So I do feel, however, right now or this year or maybe the last 12 months or so, or 6+ months, there has been some acceleration, and I think it's been driven by, again, the fact is different interest rate environment, so people starting to tokenize real world assets, money market funds, etc. We saw the recent announcement of BlackRock with Securitize. We did a money market fund tokenization of a Fidelity money market fund. So I feel that's an area where it's very easy for people to understand, okay, there's a use case, there's easier liquidity, it's on chain, it's settled much faster, you have a yield, it's attractive, it's lower risk given the counterparties involved, it's off balance sheet. So there I see a big growth potential. And then obviously the more the things that you referred to at the beginning, the use case is beautiful. If you tokenize Picasso and you have then a 5 million painting owned by 70 counterparties, then a year later we could sell it. It was auctioned and people got a 20% return in 1 year. Tokens burned. Nobody had to invest 5 million, but could also invest just 10,000. So that was nice, but we are there at the very beginning. This is not yet happening at scale. I think this will grow, but much slower than these big use cases like tokenized money market funds, etc. And again, why is there a bottleneck? Because here it's not just the infrastructure that you need and more nodes. It's also, again, this is dealing with securities, and there's already a very limited or a more limited group of entities that can deal with this legally. And those are also not necessarily the ones prone to advance with the infrastructures the fastest. And so you have this double whammy of why maybe things go a bit slower.
And I think also on the traditional side of things, there's kind of a lack of what do you settle the transaction in, right? You've tokenized a bond, but some of the experiments that we've seen have been kind of experimental CBDCs from the Bank of France that have kind of settled the transaction rather than kind of real-time things. But look, I think we're basically on time. So from my perspective, this has been a super interesting conversation. So I thank you for joining from India. I know you're on a busy schedule and look forward to catching up soon.
Thank you very much. Same. Have a great day.
You too.